Hey, good evening, everyone. Chris here, creator, lead developer, and of course, chief lazy person here at LazyFA.com. I want to welcome you and thank you for checking out the very first installment of our new weekly investment analysis series, where we're going to be competing to see who can provide the best, most thorough, or most interesting analysis of a real company using LazyFA. Now, if you've never used LazyFA before, LazyFA is an automated web application that helps you make better investment decisions. And what we do here is each Friday, we pick a stock that's been in play for that week, and we do a quick analysis of it in a video like this one. For the next week, that stock is going to be free across the entire site, so any user can jump in and use everything on the site and do their own analysis. Once you've done that, you're going to be able to use that analysis to get some free access to the rest of the 10,000 plus companies that we've got data on. So make sure that you take a look at the description of the video. All the rules and everything are in there. And with that said, let's just go ahead and dive right in. The stock that we're going to be looking at this week is FOSL Group Incorporated, and you can see that's up on your screen right now. FOSL Group, as we can see in the company information, together with its subsidiaries, designs, develops, and markets and distributes consumer fashion accessories. Okay, so this is a retail company. They sell fashion accessories, watches, jewelry. I think they've probably got some handbags and things like that, right? So they market through their own proprietary brands, things that you've probably heard of: Armani Exchange, Chaps, Diesel, DKNY, right? They're pretty well-known brands. And I thought this was an interesting case for me, because it's clearly a troubled company, right? If we look at the weekly chart, they've dropped from $45 a share in looks like what was, let's see, November, December, so late 2015 to current, right? We've gone from $45-50 a share all the way down to a low of around $5. And just recently, they released their most recent earnings, and the stock popped from around $9 a share to 16 or 17, right? So that's a huge increase, right? We saw something like a 60 or 70% gain overnight. And to me, that I don't know if their earnings are really good enough to justify a 80% gain, right? And so that's why I thought this was kind of an interesting case, because this is clearly a troubled company that had good earnings that beat expectations. But I think that there might be, some opportunities to dig a little bit deeper. So we're going to use LazyFA to just sort of dig into this thing a little bit and see what we can find. So one of the things that I always like to do, right, is on the dashboard of LazyFA, we've got several charts. And these charts show you sort of the main trends. Any of these items, right, you can plot basically anything off of the income statement, the balance sheet, the cash flow statement, whatever you want, right? And it will show you the trend over time. And so I like to just sort of look at the main things, right? Revenues, cost of revenues, net income, debt, liabilities, assets, things like that. And I try to sort of just get an overall picture of where the company stands, right? So this is annual data. I'm going to actually go down to the quarterly data just because I think that that's more accurate. It's more recent. And the first thing that stood out to me on this company, and this is one of the things that I really love LazyFA for, is just that it's really easy to see large anomalies like this over here, where we had net income rising, and it starts to fall off in, looks like around January of 2015. They started to have a little bit of trouble. And then we had this massive negative net income item in the July of 2017 quarter. So this is the first sort of red flag for me. I just want to know what caused that. So I did a little bit of digging, and it's actually really easy, right? If you look at the date, 2017 7/1. So we're talking about the July 2017 quarter. We're looking for about a $344.7 million net loss. And all I'm going to do is go to the SEC's website, go to company filings. I'm going to stick in FOSL, and I'm going to look up the 10Q for that July quarter. And that's probably going to be this one. the one that was submitted on August 10th, 2017. We're going to go into the documents. We're going to pull up the 10Q, and I'm going to Control F for net income. And one of the things that you'll notice is whenever there's a big change in something like net income, the company will usually explain it in their 10Q. And so these are all just the numbers. Net income, right here. Let's see. So we decreased to $344.7 million, or negative $7.11 per diluted share, in comparison to $6 million profit, or 12 cents per diluted share in the prior year quarter. This included a non-cash intangible asset impairment charges of $6.50 per share and a restructuring charge of 13 cents per diluted share. So the majority of that change, right, is because of this non-cash asset impairment charge. So that's the first thing that I would definitely want to know, what the details of that are. Chances are it has something to do with the fact that their brand name is maybe losing some credibility or something along those lines. But companies, they have to do these impairments every once in a while. It's common in the oil industry as well, with equipment impairment and land impairment if they haven't started drilling and things like that. So I would definitely do some digging there. And let's keep going. So that's the first thing, right? I want to understand what that non-cash impairment was. The other thing that I see, since 2012, this company has been taking on a ton of debt. And so I would want to understand what this debt's being used for and how efficiently it's being used. So I would definitely dig into the debt. Price to earnings ratio looks pretty stable relative to itself, right? I don't know how it stands relative to other companies, but we could look that up very easily. We just put them into the ticker box up here, look at the price to earnings ratio. And there's other metrics in here too that we could look at. We could look at EBITDA, we could look at enterprise value, we could look at free cash flow. There's all kinds of things that we can compare to other companies to sort of get an idea of where FOSL stands relative to its competition. So strong revenue growth, strong. And we see the most recent revenue growth was as of December 2016. Most recent revenue number was $3.04 billion, with net income sharply off from the 2015 highs, most likely in a large part due to that intangible asset impairment. We're down to just $78.87 million net income as of December 2016. Their most recent earnings just came out, so you would definitely want to look into what those were. If I remember right, they earned something like $270 million. So FOSL Group reports earnings for the fourth quarter 2017. And what we're going to do is, so the company reported a net loss for the fourth quarter of $79.9 million compared to $49.7 million for the fourth quarter of 2016. For fiscal 2017, the company reported a net loss of $478.2 million. And what about revenue? What about sales? We're interested in probably total net sales. Fiscal fourth quarter 2017, worldwide net sales decreased 4%, $38.4 million. Global retail comps increased 2% compared to the fourth quarter of fiscal 2016. Gross margin decreased. Operating income. And then, of course, their guidance. We want to look at that. So this is a long earnings release. This is a troubled company, like I said. They're in the process of making some changes to their strategy. If I remember right, the CEO had said something like they are focusing on growing their wearables sector, right? They're selling a lot of watches, and I think that's wearable watches, and I think that's That's a big reason for this increase, was that they doubled their smartwatch sales. Whether or not it justifies a 80% increase, I don't know. That's for us to keep digging. So let's look at red flags. Let's see if there's any red flags. So this is one of the cool things about LazyFA, is that it automatically digs into stuff like the income statement and the cash flow statement and looks for red flags like these. Debt load strictly decreasing. These are not super concerning to me. Revenue strictly increasing basically just means that revenue went up with no decreases. And that's actually pretty uncommon. It's almost more of a concern to me if it is true, just because companies don't have perfect trends all the time, right? They're cyclical. So these three are not super concerning. EPS strictly increasing. The monotonicity tells us how often out of all of the year-over-year periods earnings per share increase. So 79% of the time earnings is up, 84% of the time revenue is up, and debt load strictly decreasing. Only 26% of the time debt decreased. So they are taking on a lot of debt. There's more details here if you wanted to read into the explanations. No other major red flags that triggered on the income statement. Let's just take a quick look at the balance sheet. And by the way, all of these charts are interactive. If you hold Control or Shift, you can zoom in and zoom out. There's all kinds of different comparisons that you can do on these charts. Asset distribution, liability distribution. So there's lots of information here. This one, average liabilities growth outweighs average asset growth. I think that's probably obvious over the last 20 years or so, most likely skewed by the most recent data. Liabilities growth on average has been about 20%, whereas asset growth has only been about 14%. So not sure if that's a huge concern, but obviously the debt increase within the last few years is definitely something that we want to look into. As we can see here, LazyFA has also detected that there are some outliers in the debt load and outliers in the debt load growth. And basically what that means is that there was an abnormal spike at some point in the data in the company's debt load. And if you remember, it started back in 2012 or 2013. I think the threshold on this is actually 15 times the norm, whereas it looks like 2012 even was 11.44 times the normal deviation. So, even 2012 is concerning, but if we go to the dashboard, what you're going to see is that there's a connection here between 2012 and 2012 on the chart. Huge increase in debt relative to 2011. So before 2012, right, they had their debt pretty much under control. 2005 was a big spike as well. I'm not sure if that one actually showed up. So 2005 was about 3 times the deviation at that point. 2012 was a huge increase, and then 2013, same deal, right? 13, 14 times the norm. You can see that this spike on the chart is picked up by the detection mechanism, and it's getting very, very high here, right? 100 times the normal deviation over the course of the last 15 or 20 years. So debt is definitely something we want to look at. Debt load growth, same type of thing. It did pick up that 2004 to 2005 spike, and 2011 to 2012 looks like it was just under the threshold. So, and same thing with 2012 to 2013. So if we lowered this threshold a little bit, which at some point you'll be able to do that. But right now it's just set at a hard-coded 15 times the norm. So regardless of all that, debt is something we want to certainly look into. Let's take a look at the cash flow statement. No major concerns on the cash flow statement, at least not detected automatically. And then cross-statement compares items from different financial statements together. So we're looking at things like something on the balance sheet versus something on the cash flow statement and vice versa. We do have a couple here. Accounts receivable to sales growth ratio is pretty high. So accounts receivables growth was 1.28%. Revenue growth was negative 5.77%. So we've got a lot of receivables coming in, revenues declining. So obviously that's not a good thing. But I think we knew that already. Let's also look at accounts payable to sales growth. This is probably related to their debt. Accounts payable growth minus 21.36% as of 2016. This is actually a little bit weird because I think they might have changed their fiscal quarter or something. So it says 16 to 16, but if you look on the chart, we're actually talking about January 2016 through December of 2016. So this is actually technically 16 to 17, but for whatever reason, if they change their fiscal quarter or something along those lines, that's probably what's causing this. So we want to look at the ratio between accounts payable and sales growth. We also want to look at the ratio of accounts receivable to sales growth. Both of those have triggered, and so that's something that we want to look into. The only other thing that I usually look at just as a quick analysis is the Beneish M-score, and the Beneish M-score basically is a fraud detection model, and it will tell you whether or not a company is likely to be a manipulator. And so underneath each one of these charts is an explanation of what it is and what it's used for. The main thing that I'm paying attention to right here is that FOSL's M-score right now is negative 2.21, and the threshold is actually about negative 1.7 for it to be considered likely to be a manipulator. Doesn't mean that it's not a manipulator. It doesn't mean that they couldn't be manipulating earnings, but it just means that it's unlikely. So that's actually a good thing, right? You can see that their M-score is pretty much under negative 2.0 for the last 5 years or so, and that's pretty normal. So that's a good thing. It doesn't look like they are doing anything, to manipulate the numbers, at least not on the surface. And the last thing I'm going to look at is Benford's law. And this is just used to identify any kind of numerical irregularities or abnormalities in a big set of numbers. And basically what we would see here is if there was some sort of an abnormality in the numbers, right, something that was manipulated, we would see a big spike in FOSL's actual number of numbers on their income statement, for example, that started with the digit 1 versus what the expected value is, right, which is based on Benford's law. It's expected that about 30% of the numbers will start with a 1 and 17.6% will start with a 2 and so on and so forth. So this shows you their conformity to the law, and then these graphs underneath show us how far they deviated. So personally, it doesn't look like there's a ton of deviation from the norm here. It looks like just about 3%. So that looks pretty normal. So I think overall it looks like, FOSL is not, they're definitely not, manipulating the numbers in any significant way, at least not that's super obvious on the surface. But there definitely is some work to do in terms of their analysis. Or in terms of our analysis, we probably want to look at revenue and expense manipulation, make sure that they're not changing expensing policies or changing revenue recognition policies and things like that. All of that is automatically detected with LazyFA. Also back on the dashboard, we probably want to look at things like quarter over quarter growth. We want to look at maybe per share data versus the actual data. So we'll see $63.20 of revenue per share. A lot of times you'll see deviations in the actual data when you change it to per share. You'll pick up hidden things that come out because of how often they are diluting the stock. We can actually see that in this case, this is a good thing, right? FOSL for the last several years, it looks like they've been decreasing the shares outstanding. It looks like they're potentially buying back stock. Maybe that's what they're using all this debt for. Interesting trend there, but that's a good thing, right? We want to see shares outstanding decreasing or at least remaining stable, because that means that the company is not selling more stock into the market, diluting the current share base that's out there. So let's leave it at that for right now. There's obviously a ton more analysis to do on this. We want to look at their earnings. We want to look at their watch sales. We want to look at the news that is surrounding the company right now. Because it's been such a huge increase, I think that there's a lot of potential probably in both directions here. Maybe for a short trade where we're just looking for a quick pullback, maybe for some options plays where we buy puts or sell calls. I think there's a lot of potential for trades in both directions. And I also think that based on their guidance and based on the CEO's sort of positive outlook in the company, I think that it's worth investigating this. Personally, I don't buy much stuff from FOSL, so I can't personally speak to the quality of their products or anything like that. But that's going to do it for me for FOSL. Once again, make sure that you take a look in the description of the video. That's going to tell you how you can get free access to the full list of tickers on this site. We've got something like 10,000 companies, 20 plus years of fundamental data, 125 different metrics and ratios. All of this stuff is pulled directly from the SEC filings. It's pretty much the most accurate data you're going to find. So once again, take a look at the description, have fun, submit your analysis, and I will see you next week. Peace.